put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The 310 million ghost. In April 2020, a single internal memo set off a financial earthquake that would expose one of the most brazen corporate frauds in modern history. The document, buried deep within the servers of a Chinese coffee chain that had dared to challenge Starbucks, contained a confession so devastating that it would wipe out $6 billion in shareholder value in a single day. The company was Luckin Coffee, a brand that had become a national sensation, opening stores at a pace the world had never seen, serving millions of cups daily, and captivating Wall Street with its meteoric rise. But behind the blue logo and the cheerful app notifications, a conspiracy was unfolding in the shadows, one that would require fabricating hundreds of millions of dollars in sales, forging thousands of documents, and maintaining a lie so massive that it demanded the silence of dozens of executives. This is the story of how ambition rotted into desperation, how innovation became deception, and how a company that promised to revolutionize an industry instead became a cautionary tale about the price of chasing growth at any cost. What you're about to hear isn't just about fake revenue. It's about the machinery of fraud, the psychology of deception, and the moment when the entire illusion finally collapsed. The story begins not with fraud, but with genuine ambition. In 2017, Charles Lu Zhengyao, a Chinese entrepreneur who had already built a multi-billion-dollar car rental empire called Car Inc., looked at the Chinese coffee market and saw an opening. Starbucks dominated the premium coffee space in China, but Lu believed they were too slow, too complacent, too wedded to the old model of physical cafes and leisurely consumption. He envisioned something different, a technology-driven coffee company that would leverage mobile ordering, rapid delivery, and aggressive expansion to capture the emerging Chinese middle class. The pitch was seductive. China was transitioning from a tea-drinking nation to a coffee-consuming powerhouse, and whoever controlled that market would control billions in annual revenue. Lu assembled a team of former Starbucks executives and tech veterans, raised hundreds of millions from investors, including Singapore's GIC Sovereign Wealth Fund and BlackRock, and launched Luckin Coffee in October 2017. The strategy was unlike anything the industry had seen. Rather than slowly building brand recognition and profitability, Luckin would blitzscale, open thousands of locations in months, offer massive discounts to attract customers, burn through investor cash to capture market share, and worry about profits later. It was the classic Silicon Valley playbook, transplanted to the world of lattes and espressos, and for a while it appeared to work spectacularly. By mid-2018, Luckin had opened over 800 stores across China. By the end of that year, they claimed to have surpassed 2,000 locations, more stores than Starbucks had opened in China over 2 decades. The blue cups became ubiquitous in Chinese cities. The app downloaded millions of times, and the company's growth metrics stunned analysts. Customers received deep discounts, sometimes getting coffee for a fraction of its cost, subsidized by venture capital that flowed in with increasing enthusiasm. Lu portrayed Luckin not as a coffee company, but as a technology platform that happened to sell coffee, comparing his vision to Amazon and Alibaba rather than Starbucks. Investors, intoxicated by the growth story and China's massive market potential, lined up to participate in funding rounds. But behind the explosive expansion, something was already going wrong. The unit economics didn't work. Each cup of coffee cost more to produce and deliver than Luckin charged for it, even without the discounts. The company was hemorrhaging cash, burning through hundreds of millions of dollars per quarter, with no clear path to profitability. In any rational analysis, Luckin needed to slow down, optimize operations, and build a sustainable business model. Instead, Lou and his executive team made a different calculation. They had raised too much money, made too many promises, created too much momentum to admit that the model wasn't working. Wall Street demanded growth, and growth was the only metric that mattered, so they decided to manufacture it. The fraud began quietly, likely in late 2018, as a small adjustment to reality. A nudge to the numbers here, an inflated figure there. But fraud has its own momentum, its own terrible logic. Once you start lying about revenue, you must continue lying, and each quarter the lies must grow larger to maintain the illusion of accelerating growth. What began as a desperate measure to smooth over temporary problems metastasized into a systematic conspiracy involving fabricated transactions, fake purchase orders, forged bank statements, and an elaborate cover-up that would eventually implicate dozens of employees. The mechanics were sophisticated yet brutally simple. Luckin executives, led by Chief Operating Officer Jen Liu and other senior managers, began systematically inflating the number of items sold and the revenue per store. They created fake orders in the company's system, making it appear that customers were purchasing coffee, snacks, and merchandise that never actually existed. To make the fabricated sales appear legitimate, they manufactured supporting documentation, false receipts, invented customer accounts, phantom delivery records. They inflated advertising expenses to create the appearance of legitimate business costs that would explain where the fake revenue was supposedly going. In essence, they built a parallel Luckin Coffee that existed only in spreadsheets and databases, a ghost company overlaid on the real one, growing impossibly fast while the actual business struggled beneath. The scale of the deception was staggering. Between the second quarter of 2019 and the fourth quarter of 2019, Luckin fabricated approximately 2.2 billion yuan, roughly $310 million, in revenue. That represented approximately 45% of their reported annual sales for 2019, meaning that nearly half of the company's revenue simply didn't exist. To put that in perspective, they were inventing the equivalent of a mid-sized coffee chain's entire annual sales out of thin air every single quarter. The fraud required coordination across multiple departments: operations, finance, technology, and the complicity or willful blindness of numerous employees who processed fake transactions, created false reports, and maintained the charade in their daily work. But here's what makes this story truly disturbing. The fraud was working. Investors believed the growth story completely. In May 2019, Luckin Coffee went public on the NASDAQ in one of the fastest IPOs in history, just 18 months after the company's founding. The offering raised $561 million and valued the company at $4.2 billion. Shares surged 20% on the first day of trading as institutional investors rushed to own a piece of the Starbucks killer. Financial analysts published glowing reports praising Luckin's execution and market opportunity. Just 6 months later, in January 2020, the company raised another $1.1 billion through convertible bond offerings, with investors including BlackRock and Barings eagerly participating. At its peak, Luckin Coffee was valued at over $12 billion, more valuable than many established global brands. While Lou and his executives celebrated their success and continued fabricating revenue, someone was watching from the shadows. In January 2020, an anonymous research firm called Muddy Waters Capital received an 89-page report from an unknown source, a document that would later be described as one of the most detailed exposés of corporate fraud ever compiled by independent researchers. The anonymous author, identifying themselves only as someone with great passion for uncovering the truth, had conducted an extraordinary investigation into Luckin Coffee's operations. What they discovered was damning. The investigator had deployed teams to physically watch 620 Luckin Coffee stores across 45 Chinese cities, recording 11,260 hours of store traffic and 25,843 customer receipts over a period of several months. They installed video cameras to count customers, hired investigators to pose as consumers and track actual sales, and meticulously compared the real transaction data with what Luckin reported in its financial statements. The numbers didn't match, not even remotely. The physical surveillance suggested that actual sales per store were far lower than Luckin claimed, sometimes by more than 50%. The report documented systematic inflation of the number of items sold per day, impossible spikes in transaction volumes that had no basis in observable customer behavior, and advertising expenses that appeared to exist only on paper. Muddy Waters founder Carson Block, a legendary short seller with a track record of exposing fraudulent Chinese companies, reviewed the anonymous report and found it credible. On January 31, 2020, Muddy Waters publicly announced it was shorting Luckin Coffee stock and released the damning research report. The document accused Luckin of inflating sales by at least 88% in the third and fourth quarters of 2019, fabricating transactions and perpetrating a massive fraud on investors. It was a declaration of war against one of the most hyped IPOs of the decade. Luckin's response was immediate and emphatic. They denied everything. The company released statements calling the report misleading and false, accusing Muddy Waters of trying to profit from market manipulation by driving down the stock price. They claimed the anonymous investigators' methodology was flawed, their sample size unrepresentative, and their conclusions based on fundamental misunderstandings of Luckin's business model. Many analysts sided with Luckin, pointing to the company's rapid expansion, its backing by sophisticated institutional investors, and its audited financial statements prepared by major accounting firm Ernst & Young. The stock dipped briefly but recovered. Investors wanted to believe the growth story more than they wanted to believe the fraud allegations. But inside Luckin's headquarters in Xiamen, China, panic was spreading. The Muddy Waters report had exposed the fraud in frightening detail, and executives knew it was only a matter of time before regulators, auditors, or their own board discovered the truth. They had two choices: come clean immediately and hope for leniency, or double down on the lies and hope the storm would pass. For weeks they chose to fight, marshalling public relations resources, hiring expensive law firms, and preparing to defend themselves against what they publicly characterized as a baseless short-seller attack. Behind closed doors, however, they began preparing for the inevitable. In late March 2020, as the world grappled with the emerging COVID-19 pandemic, Luckin Coffee's board of directors formed a special committee to investigate the fraud allegations. They hired international law firm Kirkland & Ellis to conduct an independent investigation into the company's accounting practices. What the investigators uncovered was worse than anyone had imagined. Not just isolated discrepancies, but systematic, coordinated fraud extending across multiple quarters and involving senior leadership. The evidence was undeniable. Fake receipts, fabricated purchase orders, forged bank statements, and internal communications showing explicit coordination of the deception. On April 2, 2020, Luckin Coffee released a bombshell announcement that sent shockwaves through global financial markets. The company admitted that its chief operating officer, Jian Liu, and several employees reporting to him had engaged in misconduct, including fabricating transactions. The admission confirmed that approximately 2.2 billion yuan, $310 million, in revenue from the second quarter through the fourth quarter of 2019 was fake. The company announced that Liu and other implicated employees had been suspended and that previous financial statements should no longer be relied upon. It was a corporate death sentence delivered in the cold language of regulatory filings. The market's reaction was apocalyptic. Luckin's stock price, which had closed at $26.20 the previous day, plummeted 75% to $6.40 when trading opened. Over the following weeks, it would fall further, eventually trading for less than $2 per share, a destruction of more than $6 billion in market value. Institutional investors who had poured hundreds of millions into the company watched their investments evaporate. BlackRock alone reportedly lost over $200 million on its Luckin holdings. The scandal triggered a broader crisis of confidence in US-listed Chinese companies, with investors questioning whether any Chinese company's financial statements could be trusted. The NASDAQ moved quickly to delist Luckin Coffee, and regulatory bodies around the world launched investigations. The U.S. Securities and Exchange Commission filed fraud charges against the company and several executives, alleging they had orchestrated a scheme to defraud investors by materially overstating the company's revenue, expenses, and net operating losses. Chinese regulators fined the company 61 million yuan, approximately $9 million, for falsifying financial records and deceiving investors. The company's auditor, Ernst & Young, faced intense scrutiny for failing to detect the fraud despite conducting supposedly rigorous audits. As investigators dug deeper into Luckin's operations, they uncovered a conspiracy far more extensive than the initial admission suggested. The fraud wasn't limited to a rogue COO and a handful of subordinates. It extended to the highest levels of the company and implicated the founder himself, Charles Liu. Documents revealed that Liu had personally benefited from the fraud in ways that made him complicit, if not directly involved in orchestrating it. Before the fraud was exposed, Liu had used his Luckin shares as collateral for massive personal loans, totaling hundreds of millions of dollars. He had pledged stock, representing more than half of his ownership stake to secure these loans, borrowing against the artificially inflated value created by the fake revenue. When the fraud was revealed and the stock collapsed, those loans became underwater, meaning Liu had extracted enormous personal wealth from the company based on lies before the truth emerged. Investigators concluded that Liu had personally profited from the fraud to the tune of at least $200 million, money he had effectively stolen from investors by borrowing against fraudulently inflated shares. The SEC's investigation revealed even more disturbing details about how the conspiracy functioned. Senior executives had held secret meetings to coordinate the fabrication of revenue numbers and discuss how to maintain the deception. They had created encrypted communication channels to discuss the fraud away from official company systems. They had prepared fake documentation in advance of audit inquiries, coaching employees on how to respond to questions from auditors without revealing the truth. Multiple employees who became aware of the fraud faced implicit and explicit pressure to remain silent. Their careers, their livelihoods, and potentially their personal safety dependent on maintaining the lie. In September 2020, Luckin Coffee settled with the SEC, agreeing to pay a $180 million penalty, one of the largest fines ever imposed on a company for accounting fraud. Charles Liu was personally barred from serving as an officer or director of any U.S. public company and agreed to pay a $9 million penalty. Former COO Jian Liu was also barred and fined, and several other executives faced criminal and civil penalties. But the settlements didn't bring back the billions in lost shareholder value, didn't restore investor trust, and didn't answer the fundamental question that haunted everyone involved. How had so many sophisticated investors, analysts, and auditors been fooled so completely? What makes the Luckin Coffee story even stranger is that it didn't end with the fraud's exposure. After admitting to fabricating hundreds of millions in revenue, after seeing its stock delisted from the NASDAQ, after paying massive fines and watching its executives face criminal prosecution, Luckin Coffee somehow survived. The company filed for bankruptcy protection in the Cayman Islands, but continued operating stores in China, where millions of customers still bought coffee daily. Real coffee from real stores, generating real revenue. Under new leadership, Luckin restructured its business, cleaned up its accounting practices, and gradually rebuilt credibility. Remarkably, by 2023, the company had not only recovered but thrived, operating over 13,000 stores across China, far more than at the time of the fraud. It had become genuinely profitable, generating real sales that finally matched the growth story Lu had originally promised. The company's restructured shares, trading over the counter, climbed back into profitability for some investors who had held through the crisis. It was an unprecedented resurrection. A company that had perpetrated one of the largest accounting frauds in history, somehow emerging stronger on the other side. But the cost of the fraud extended far beyond Luckin itself. The scandal accelerated U.S. regulatory efforts to crack down on Chinese companies listed on American exchanges, leading to the passage of the Holding Foreign Companies Accountable Act, which requires foreign companies to comply with U.S. audit inspections or face delisting. Hundreds of Chinese companies were forced to delist or face intense scrutiny, and investor confidence in Chinese business practices suffered lasting damage. The fraud also exposed fundamental weaknesses in the audit process, raising uncomfortable questions about how major accounting firms could fail so spectacularly to detect systematic fabrication of revenue occurring right under their noses. For the investors who lost billions, for the employees who built their careers at a company founded on lies, for the customers who unwittingly participated in a charade, the Luckin Coffee scandal represented a betrayal of trust on a massive scale. It revealed how easily growth narratives can seduce even sophisticated investors, how pressure to meet expectations can corrupt entire organizations, and how the machinery of fraud can operate in plain sight when everyone involved has an incentive to believe the illusion. The Luckin Coffee scandal offers chilling insights into the psychology of corporate fraud and the dangers of growth at all costs business models. Charles Lu's original vision wasn't inherently fraudulent. He genuinely believed he could build a technology-driven coffee empire that would challenge Starbucks. But the blitzscaling strategy he chose created a trap. Once you promise exponential growth, once you raise hundreds of millions based on that promise, you become locked into a trajectory that may be impossible to sustain. When the reality inevitably falls short of the promises, executives face a terrible choice: admit failure and watch the company collapse, or manufacture the appearance of success and hope you can eventually grow into the lie. Luckin chose to lie, and that decision contaminated everything that followed. Fraud has its own logic, its own momentum. Each fabricated quarter makes the next one harder to correct. Each fake transaction requires more fake transactions to support it, until the entire organization becomes complicit in maintaining a fictional version of reality. The executives who orchestrated the fraud weren't comic book villains. They were ambitious people who made a catastrophic decision under pressure, then found themselves unable to escape the consequences of that choice. The scandal also exposes uncomfortable truths about the investment ecosystem that funds modern startups and growth companies. Luckin's investors included some of the most sophisticated institutional funds in the world: sovereign wealth funds, major asset managers, experienced venture capital firms, and virtually none of them detected the fraud. They were so captivated by the growth story, so eager to capture exposure to China's enormous market potential, that they failed to ask hard questions about the unit economics, failed to scrutinize the operational metrics, failed to verify that the growth was real. In their defense, Luckin went to extraordinary lengths to conceal the fraud. But the scandal reveals how momentum and narrative can overwhelm due diligence when everyone wants to believe in the next big thing. Perhaps most disturbing is what the scandal suggests about the relationship between perception and reality in modern business. For nearly 2 years, Luckin Coffee existed in two forms simultaneously: the real company struggling with profitability and challenging unit economics, and the fictional company generating impressive growth metrics that thrilled investors. The fictional version generated hundreds of millions in investment, created billions in market value, and shaped business decisions throughout the coffee industry, as competitors tried to respond to Luckin's apparent success. In other words, the fake Luckin had real-world consequences, influencing capital allocation, competitive dynamics, and strategic decisions across the sector, all based on numbers that didn't exist. It's a reminder that in modern financial markets, perception can matter as much as reality, at least until the illusion finally breaks. The story of Luckin Coffee doesn't answer the question it raises. It haunts you with it. How many other companies are running the same playbook right now, inflating metrics to sustain unsustainable growth stories, trapped in the same desperate cycle that destroyed Luckin? How many ambitious founders have made the same calculation that Charles Liu made, that survival requires deception, that the only way forward is to fake it until you make it? Consequences be damned. The machinery of modern growth investing, the pressure for exponential scaling, the worship of metrics over fundamentals, the FOMO that drives capital into companies with impossible valuations, creates conditions where fraud becomes almost logical, a rational response to irrational expectations. Luckin Coffee ultimately survived by becoming what it should have been from the beginning: a real coffee company with sustainable economics and realistic growth expectations. But thousands of investors lost billions learning that lesson, and the broader market learned something darker: that even sophisticated due diligence, major auditing firms, and regulatory oversight can fail to detect fraud when the incentives to believe are strong enough. The scandal exposed the uncomfortable truth that lies at the heart of the growth economy: that much of what we call value is based on stories, projections, and promises about the future, and that those narratives can be manipulated by anyone desperate or ambitious enough to do so. The next time you see a startup promising exponential growth, disrupting an industry, scaling faster than anyone thought possible, remember Luckin Coffee. Remember that behind every impossible growth story might be a very human conspiracy. Executives in conference rooms fabricating numbers, employees pressured into silence, and a ticking clock counting down to the moment when reality finally catches up to the lies. Because in the end, that's what Luckin Coffee really teaches us. You can fake growth, you can fool investors, you can even build a multi-billion-dollar valuation on fabricated revenue, but you cannot escape the mathematics of truth forever. Eventually, always, the real numbers surface from the shadows, and when they do, the entire illusion collapses in a single, devastating day. That's the dark side of business, where ambition becomes fraud, where innovation masks deception, and where the line between vision and delusion disappears entirely, leaving only the wreckage of broken promises and the billions lost to a lie that everyone wanted to believe. Subscribe and listen to our next story below.